Our special guest today, Aashish Somaiyaa, CEO at WhiteOak AMC, joining us this afternoon to give us perspective on how he's viewing markets. Hi Ashish, Harsh here, good chatting with you. Ashish, first off, how are you viewing the Indian market at this point? We've now started to see a bit more calm start to come through. What's your sense at this point, and how are you viewing it, the whole global context, along with how India is placed?
Yeah, I think, I don't think we should draw too much comfort from, couple of days of up move, really. I think there is still, a lot of uncertainty is what I would say. First of all, obviously, because if you see the way US and China, there has been some sparring, and then intermittently European Union and, other things. So while we have been more of a, for lack of any other word, more of a sideshow, but clearly the risks are still not fully mitigated. And in the last few days itself, we have seen statements flying back and forth. Of course, there is some talk about people coming to a negotiating table, and but I think the disruption for some time is here to stay. So today, I mean, we are drawing comfort from some developments over the long weekend that we had. And then maybe tomorrow or day after, we again run the risk of some statements coming by. So while local conditions in India have been improving, and at the same time, we seem to be seen to be at least a medium to long-term beneficiary of what is happening. But I think in the short term, stock markets globally do tend to get correlated. So right now we are dancing to American tunes, or tunes of stock markets globally. And from that perspective is what I said, that from time to time you will see two steps forward, one step backward, those kind of movements and high volatility.
Ashish, so want to get this absolutely clear. Do you believe that there's going to be more volatility, or do you believe that we run larger risks? Because both would be mutually exclusive technically. Volatility will likely lead to opportunity, but risks, do you believe India runs a large risk per se? Is that how you're viewing it?
So I would clarify that I don't see India directly as a market or directly as a participant. I don't think we are directly running big risks. What I meant to say is that till the time the global scenario is uncertain, you will find very high volatility, and high volatility is basically a marker of the fact that all market participants put together cannot wrap their arms around what the possibilities and what the fallouts are going to be. So when I meant high volatility, I meant more to do with the global scenario, more statements flying back and forth from the major economies in the world. And that could also result in downside, is what I meant, because while we are not directly impacted, or while one is bullish about India's prospects, the reality is that in the short term, all markets get correlated. We have seen this, over 20 years, we've seen it at least 3-4 times, that globally, when the economy is slowing down, or if there is some risk emerging out of, say, US economy or US markets, then, US being the biggest market, everything gets correlated. And even if our corporate performance or even if our earnings are not impacted, at least in the short term, because of correlation with markets, even we have witnessed downsides.
Right. Now, if you talk stock specific or sector specific here, IT sector. Now, we have seen a sharp correction when it comes to the IT sector, obviously because of the recession risk that is pertinent. Obviously, that will lead to lower spends in the global market, which could indirectly impact them. But do you see after this correction that the valuations have now priced in the lower spends that could impact their top line, or still there could be some more downside to the IT space?
So see, our belief is that it's a good contrarian bet, if you really ask me. And over the last few years, there have been many times where obituaries have written and very negative kind of indications have been given out about IT as a sector. So I think if you really see, our sense is that valuations are attractive. It has been on a, I mean, there have been ups and downs, but right from October 2021, it has been a rank underperformer. So I think that is something to keep in mind. And markets obviously will react to relative pricing and relative valuations. So from here on, our sense is that it's a good bet. The second important thing is that I must be mindful that whenever we say IT, see the way we manage our funds versus how IT in conversations is perceived. I just wish to clarify that when we run IT funds or digital funds, 30-40% of our portfolios are big tech or what we see as IT traditionally. Another 30-40% of our portfolios could be digital or digital businesses. And then there could be telecom and ancillaries and others. So when we run funds, we run reasonably broad-based funds. But I can imagine your question is on a big IT. And from that perspective, I think the worst is behind us.
It was on the large cap IT like TCS, Infosys as well. Now, from global market to domestic market, if we shift focus, cement is one sector where capital expenditure has been increasing, cement demand has been increasing, pricing is one factor which is on the negative side or has been pretty much stable, because of which there has not been much of a re-rating when it comes to cement space. But now going forward, do you see that given the capex increase that will come in and given the lower raw material cost, there could be some kind of a re-rating that could happen in the cement space, because that sector has been in a lull for quite a long time now?
Yeah, I think, see, clearly one driver is real estate cycle, because in the last 3 to 4 years, there has been significant inventory absorption, and now, across the board, you can see project announcements and stuff. So real estate cycle is one, consolidation in the sector is other. And the third is obviously as far as the government is concerned or as far as the capex push is concerned, and then followed by hopefully some private sector capex. So, I agree with what you pointed out. I think it is likely to be on a uptrend or likely to be in an improvement phase going forward, and one would be constructive.
Ashish, wonder what your take with regard to banks is. Of course, it's the largest allocation in your portfolio as I see it, at least in the flexi cap fund. And a large chunk of it is skewed towards the two largest banks, the way I see it at this point, ICICI and Kotak in the private sector space. ICICI and HDFC, I beg your pardon, those are your two largest bets within private banks. What's the rationale behind this? Because you've got one which is a very solid outperformer, has been a rank outperformer in the last 3 to 4 quarters, and then you have the other who's been the rank underperformer. So what's the rationale? Give us the thought process.
See, there are, I think, 3-4 things to be kept in mind. I mean, when you see, you mentioned, say, Kotak Bank, HDFC Bank, see, a couple of them obviously have had management changes. That tied with huge amount of FII selling consistently. I mean, if you see the year 2022, and then again, if you see fag end of 2024 or early 2025. So the reason for underperformance is 3 or 4 things. One is management changes and what the market perceives of the fallout of management changes. Second is obviously some amount of headwinds, because in the last 3 years, what has worked in the markets is everything which is cyclical, macro-driven, policy-driven, right? And on the other hand, typically if you see fund houses, there are a lot of large fund houses which are so-called, say, value-leaning, right, or cyclical, correct? And on the other hand, if you see the other side is, troubled with FII selling and outflows. I mean, 21-22, we had 30-35 billion outflow, and the last 6-7 months itself is about 25 billion outflow. So there are fundamental reasons, and then obviously there are these technical reasons related to fund flows. But net-net, as a result of this, what has happened is that now for 3-4 years, there has been significant underperformance, and performance going forward. Fundamental performance, actually, the incremental markers are in favor. So if you see RBI's policies, if you see our economic conditions, so the delta change is clearly in favor when you speak about these banks. And I think even the fund flow scenario, given what is happening in global markets, given what is happening in the US, at some point in time, even the fund flow scenario might rotate. So my sense is that that kind of gives you a broad picture of why we have some of these banks as the top holdings, because that's where the relative value is, that's where the underperformance has been, and that is where the incremental news is likely to get positive.
You're right, Ashish, when you seem to suggest that there is no margin pressure in a significant fashion anticipated, or that you anticipate on these banks.
No, see, I think that if you see, there is likely to be significant amount of growth going forward, right? And thus the big banks clearly are able to choose their business. Plus, you see, like over the weekend, one of these big guys also, reduced saving bank rates. So I can understand where you're coming from, but I think typically when the market is expanding, when the credit is set to grow, the larger banks are able to pick business and grow in a selective or a cautious manner as well. So I think that those concerns would be taken care of.
And Ashish, your portfolio also is skewed more towards large cap than mid and small. Is that how you're looking at it? And any cash that you're sitting on in terms of your portfolio allocation?
No, not really. See, in the flexi cap, let's take that as an example because that is what I saw flashing here. So you would see
Correct.
about 63, 64% in large cap. In fact, you will see about 24 or 25% in small cap, right? And nearly say 10% mid cap. Now, what you need to look at is that in a flexi cap fund, large cap obviously is top 100 stocks. Mid cap is the next 150 stocks. But if you see, because it is flexi cap, what you would see as small cap is actually, not just the 250 stocks by definition, but also some of the long tail. And I think the long tail is where a lot of ideation is happening. So, I wouldn't say this should not be seen as defensive. In fact, it would be seen as in a flexi cap context. It would be seen as a portfolio which is really seeking out opportunities in the micro cap, small cap kind of space. And the stance also shows that specifically what we call mid cap, the 150 stocks, is not where our team seems to be finding much value. So in terms of pecking order, you would usually find large cap, then mid cap, then small cap. But here, I'm sure you've noticed deliberately the portfolio construct is large cap, then small cap, and then mid cap. And that is because small cap is the bigger universe right down to the tail, and that is where a lot of ideation is happening. As far as cash is concerned, it would be only something which is procedural in nature, but definitely, there are schools of thought on whether one should take cash or not. We belong to the school of thought which says that the outperformance should come from stock selection and not from asset calls. I mean, there's no right and wrong in this. Our belief is that we should outperform by remaining in equity. We should not try to beat the equity index by buying some other asset class, which may be cash or whatever it is.
Right, sir. And sir, just before we let you go, it's a two-part question firstly. The first part is, where are you deploying the incremental funds that you're getting? And the second part is, which are those sectors where you're sitting on the sidelines, and if there is a bit more correction, then those sectors might look attractive. So could you just take us through that?
See, I think if you see our portfolio, we spoke about financial services. I think the play, and we did have a couple of discussions on the banks. But if you see beyond the banks, what is interesting is there is 32% exposure to BFSI, but it's very widespread. It's not just banks. I think there is value in NBFCs, and beyond that in all the capital market businesses. So if you see in the last month or two correction, even the capital market businesses are down about 40-50%. Now, I always feel that they are not as cyclical as the market makes you believe. And I'm not talking just broking companies. If you see asset management, wealth management, the wider space of capital markets is not as volatile as the market makes it out to be. So clearly that has become attractive. The second is, if you ask me, what is it that one would want to look at, say the consumer space. Consumer discretionary, we do have exposure which is higher than the benchmark. But my sense is that if there is more correction, then consumer discretionary allocation would actually go up. So capital markets and consumer discretionary is a space to watch according to us. For more corrections, it would make it more and more attractive. But otherwise, if you really say, for example, even pharmaceuticals, our belief is that the back and forth of commentary emerging out of the US has played havoc. But otherwise, it's a sector where we are significantly overweight and we continue to be constructive. So financials, IT I mentioned to you is more a contra bet. And then there is consumer discretionary, and then there is healthcare, cement, industry, domestic capex. So out of whatever has done well in the last 3 to 4 years, I think manufacturing and capex is what we think is sustainable.
What within consumer discretionary, Ashish, are you betting on?
So it is all not necessarily. So it's a wide-ranging thing, right, from auto ancillaries, etc. But if you ask us specifically in our portfolios, It is more to do with, the upper end of retail consumption, the stuff which you talk about rising per capita incomes. So, whether it is retailing, whether it is apparels, whether it is beauty products, eating out, the whole thing about spending, urban spending, luxury, hotels, travel, all of those.
Taken. Thank you so much, Aashish, for coming in, giving us those views. Critical at this point to get that perspective. So thanks for coming in and speaking with us. Great having you.
Thank you.